On January 26, 2022, the Federal Reserve signaled plans to begin hiking interest rates, possibly in March, as it tries to tackle sky-high inflation. This video will show you why the Fed is set to raise interest rates at such point in time, and what might happen after the Fed's interest rate hikes. Please watch till the end. You'll know how to benefit from the next market crash and recession, and this may change the rest of your life. Why the current QE is different from the past? Cutting the interest rate is a conventional method, while quantitative easing is unconventional. QE involves central banks directly printing money and is used under certain extreme circumstances. The 2020 U.S. stock market crash forced the Fed to restart QE, that is, the current QE infinity, while directly cutting interest rates to zero. Otherwise, the U.S. would undergo a financial crisis amidst the COVID-19 pandemic. In the past, the U.S. dollar capital reaped the world based on acquiring foreign assets at a low price and then selling them at a high price. The reaping was typically completed when the Fed tightened monetary policy and global asset prices plunged to bottom levels. However, during the current QE infinity, the huge amount of money that the Fed has released has flowed throughout the world and caused global commodity and asset prices to rise. This has made it impossible to complete the reaping in the same way as in the past. To complete the next reap, the first thing that the Fed should do is to raise global asset and commodity prices to a record high level. Then, after the Fed raises interest rates, the global asset and commodity bubble bursts, and prices plunge to a bottom level. At this moment, the dollar capital will start to snap up quality asset bargains that the bursting bubble creates. Now, the largest bubble throughout the world is the U.S. stock market. If the Fed now starts to raise interest rates, it will puncture the U.S. stock bubble. Before the Fed starts to raise interest rates and overseas U.S. dollar capital returns from abroad, the surging U.S. dollar liquidity will continue to inflate the global asset price bubble. Although the Fed has started tapering to reduce debt purchases, this only slows down the speed of printing money, but it is still printing money and surging U.S. dollar liquidity. The naked truth: why did the Fed change its framework? After the breakout of COVID-19 pandemic, the Fed launched QE Infinity. Also in the same year, the Fed revised its mandated objectives and announced the landmark policy shift in August 2020. Its new framework puts more weight on bolstering employment and less on controlling inflation. The Fed adopted two major changes to its framework. First, it will make policy decisions based on shortfalls from full employment. This implies the Fed will continue to combat the unemployment without alerting unemployment falling too fast or far. Second, it redefined its inflation goal in terms of the average inflation rate of 2% instead of the inflation rate at a point in time. This change substantially incorporates a loose form of average inflation targeting. Why did the Fed change its framework? The changes to the Fed's policy framework have allowed for the U.S. economy to run longer at lower levels of unemployment and low interest rates, that is, to leave room for the Fed to keep interest rates low even as employment increases. To think about the changes more deeply, keeping interest low for an extended period tends to constantly push U.S. stock prices to an all-time high, while waiting for turbulent U.S. dollar liquidity to push global asset prices to an all-time high. When global asset prices and U.S. stocks are at an all-time high, U.S. dollar capital can have a chance to buy overseas quality asset bargains that the bubbles bursting has created after the Fed raises interest rates. What will happen after the Fed's interest rate hikes? Since World War II, the U.S. dollar has been dominating the global monetary and financial system and trade settlement system. The U.S. dollar is the world currency and the main reserve currency of all countries in the world. This means the Fed is the equivalent of the world central bank, and the U.S. dollar is also a world currency. Therefore, when interest rates increase, it will not only impact the U.S. economy, but also have a far more sweeping impact on other economies. For the U.S. stock market, the Fed's interest rate hikes means tightening U.S. dollar liquidity and increasing U.S. dollar funding costs. The rise in U.S. stocks is positively impacted by U.S. dollar liquidity. Tightening liquidity means U.S. stocks are about to pull back. Why is a pullback instead of a plunge? Figures shared by FactSet tells after the first rate hike of a cycle, the S&P 500 on average has moved 1.8% lower in the 3 months, but then it has stood 4.6% higher after 6 months and 7.7% higher after 12 months. The last surge has been driven by the return of U.S. dollar capital from abroad that the Fed's interest rate hikes created. Some capital returned to the U.S. stock and bond market, and then sustained the market rebound and subsequent rise. Some flowed into the real economy and promoted real investments and capacity expansion. The capacity expansion not only somewhat cooled inflation, but also maintained the mid to long-term recovery and growth of the U.S. real economy. Wall Street is bracing for more volatility over the next 12 months, on average expecting the S&P 500 to end 2022 at 4,843, according to a poll by Bloomberg in November 2021. However, analysts are divided about what the S&P 500 might happen over 2022. Mo Capital Markets thinks it will surge to 5,300 by the end of 2022 as the recovery continues, and Fed policy remains supportive. But Morgan Stanley reckons it will be lower at 4,400. The Fed's raising interest rates will eventually puncture the asset bubble and trigger a global financial crisis. For emerging economies, the outflows of U.S. dollar capital that the Fed's interest rate hikes created means a catastrophe. The U.S. capital that originally had flowed into the investments of emerging economies would turn around and return to the U.S. after the Fed's interest rates hikes. Most emerging economies rely heavily on the U.S. dollar system for their economic development. Many of them also support the free convertibility of the U.S. dollar. Once the Fed raises interest rates, a large amount of U.S. dollar capital will flee, which will impact the country's financial stability and cause a shortage of foreign exchange reserves. Once these countries do not have sufficient foreign exchange reserves to pay their foreign debts, there will be a regional financial crisis. After that, the exchange rate of the local currency plummets, the price of domestic assets plummets, and then the U.S. dollar capital goes back again to snap up their quality assets at a bottom price. The end. The Fed is set to raise interest rates soon, possibly in March. At this point in time, global asset prices might have been at a dangerous all-time high, and the conditions for reaping the world might be ready in place. After several continuous interest rate hikes, the global asset bubble will burst, which will subsequently trigger the global financial crisis and the Great Recession. Looking at research from Crescat Capital, looking back over a century of historical date, every time the S&P 500 earnings yields are near an all-time low, a significant market meltdown always comes, such as the 1929 Great Depression, the 1937-8 recession, and the 2000 tech bubble. Today's earnings yield tells the next market meltdown is on the horizon. For every one of these periods, the stock market reversed from very bullish multi-year trends, with an average subsequent 3-year performance of minus 53%. If such an all-time low comes again, it is very likely to represent a new bottom-feeding opportunity for investors. Going back over history, after every crisis, the Fed had to restart easing policies to stimulate the economy and increase the volume of printing money again. During the next recession, the next QE infinity will come again. Also, we may see the US dollar constantly depreciating after pump priming and negative interest rates coming. You see, history is a cycle that constantly repeats itself.